A philosopher once said, genius is the ability to simplify a complex subject. So Bart, as a practitioner of the gray science of economics, today all we're asking you to do is to be our personal Olympic torchbearer through the current economic haze. So our first question is, Canadian media focuses so much on our neighbor and its ills that it seems investors are ignoring mega trends that can help them prosper, such as Credit Suisse reports that 50% of global mineral demand comes from China. Do you agree with this statement?
Well, certainly a large portion of mineral demand comes from China. It's not exactly 50%. It very much depends for what particular commodity. It is rather true for the steel-related materials, but not so true for other things like energy, for example. But China is becoming an increasingly important user of commodities, ranging from copper to zinc to oil to aluminum. And that is a trend that is going to continue well into the next century.
Is this a long-term commodities revenue stream good for Canadian miners, or do you think what we're going to be seeing is that BRIC are going to be coming in and eating our lunch?
Well, I think long-term demand growth and high prices are a very positive development for Canada and Canadian producers. It will certainly help the revenue base, it will certainly help productivity, and it will certainly help investment activity within Canada and within this sector in particular. And certainly the employment created in the sector will have spin-off effects on the broader economy, everything from retail to telecommunication services.
Your excellent global mining research report for October was decidedly bullish. Can you talk a little bit further and expand on that?
Certainly, it was bullish for several reasons. One, of course, China. China is coming back to trend growth, but a bit more interestingly now is our focus on the United States. We see the United States and generally the OECD doing better going forward. That means the developing world will certainly serve as an anchor and the driver for growth. But for this year at least, for 2010 and into 2011, we're going to see the emergence of the United States and the rest of the developed world as a driver for commodity demand, as industrial production recovers, as restocking takes place. I think increasingly over the next several quarters, it will be the developed world that is the big driver of commodity markets.
And what you're suggesting then is that the United States is going to get back on track and they're going to be bidding up the price of copper.
What is going to be interesting is that the United States will become a bigger, their demand for copper is going to grow. And that hasn't happened for a few years. If you recall, we had a massive decline in housing activity in the United States. We had just a destruction of the U.S. Automotive sector. And now both of those sectors are in recovery mode. And what we're likely going to see is a bounce from the bottom. I do acknowledge that the level from which we're coming is low, but growth is growth. It will actually contribute to positive growth, and that is new. We haven't seen that for a while. Now, the important thing is that we have that stimulus coming in, which will likely encourage consumer activity. So I don't think we're nowhere near as negative on the outlook for the United States as a lot of other observers are. I think the short term looks fairly robust and in no small way because of this stimulus that is yet to be spent. Only about 20 to 25% of the stimulus money has been spent. There are hundreds and hundreds of billions of dollars yet to hit the real economy. That hasn't happened yet, and it's about to.
Which commodities do you anticipate changing most dramatically in 2010 and 11?
Well, we like copper the most.
You do?
We do. Several reasons. Biggest one is China doesn't have any, and that means they're a big net importer of copper. That means they cannot distort the market like they have been with other metals. Reason number two, we see fairly robust demand going forward, not only from China, but increasingly from countries like India over the longer term as they develop their infrastructure, as they develop their productive capacity. In essence, as they want to join the industrialized nations of the world in development and standard of living. We're going to continue to see increases in urbanization rates in those countries. And I think we're going to see relatively modest but steady growth in the developed world. And on the supply side, with copper, there are only a limited amount of projects in the pipeline, so to speak. And when one takes into account the amount of labor negotiations taking place in the copper sector right now, we will likely have much bigger than normal disruptions due to labor negotiations and other issues. That essentially means that the surplus in copper for 2010 may be a lot smaller than the consensus is thinking. And we expect an actual deficit in 2011. So no one should really be surprised why markets are so positive on copper at this point.
So your call on copper is what?
We're looking at $3.30 as an annual average by 2011.
Your team suggests the industrial commodity rally will unwind in the near term. Can you define near term and how much of an unwind?
Near term is in the next few weeks, few months. This report was written October 9th. There's a bit of a risk out there if equity markets correct. And if that's the case, we would likely see a bit of a correction in metals like copper and others. They have gone up quite a bit. They are very, very high on the cost curve at this point relative to the cost curve. And imports of copper, for example, and other materials into China could slow down. They've been importing at a record pace. And at this point, relative to current demand and supply numbers, it looks like they might have imported a little bit too much temporarily. And there is a risk that may slow down a little bit. And if we get at the same time an environment where the equities are correcting and there is a reduction in risk taking broadly, commodities could suffer.
I've been concerned about credit. You've mentioned it and so on. What impact do you think that's had on the lack of development and lack of exploration in the mining sector?
Well, judging on some of the equity issues, I don't think a lot of these firms had a big problem in raising capital. Certainly those that weren't able to go into the equity market and had to rely on other sources of credit, that was quite expensive based on historical norms. After the collapse of Lehman Brothers, we've seen the interest rates charged on securities for higher risk ventures spike. Those are coming back to more normal levels. But I think the better firms, the firms with a bit of a name, didn't have an awful lot of problems raising money as far as I know.
But what about the developers, those juniors with 43-101 defined resources? Do you think they'll be able to find funds at reasonable rates to build mines?
I think anybody with a decent resource and good bank relations should be able to do it, and certainly in this price environment, where I think the consensus is building that for at least some commodities, the future is going to be bright indeed.
Bart Melek, here's the real key one. If Canadian mining companies are in for a long-term, 36-plus month period of commodities and price stability, if not growth, which is what you seem to be suggesting, is it a time for a buy and hold strategy for investors?
Well, I think if one is to position themselves in this sector, I would suspect the producers are a better deal than the underlying commodity itself. Quite a few of them have great potential to increase their resource, to actually grow cash flow and production, and ultimately I think taking positions in the broad equity market with a focus on commodities is probably not a bad strategy going forward.
Bart, thanks very much for your extraordinarily insightful views as to where we're going in this market. We really appreciate your time, your expertise, and hopefully all your good news will eventuate.